Bond yields continue to grind lower, with the US 10-year now yielding just over 1.6%, just having been within 5 basis points as well from an inversion with the 2-year part of the curve. More and more Western economies are now grappling with negative rates, and Germany has recently seen negative yields across the curve. And what's all this mean, and where does it take us? Well, Daniel Lacalle is chief economist at Tressis. He joins us now. Daniel, welcome. Good to talk to you.
Thank you very much.
Great time for you to come in because we've got a ton of stuff to discuss. But I want to begin first of all on these yields. What's it mean?
What it means basically is that the bond market is telling us that the inflation expectations are way too optimistic in the sense of expecting inflation to pick up a little bit into 2020, and that global growth expectations are also too optimistic. So I think that what investors are doing is going into the safest assets, even if they're expensive, knowing that central banks will probably introduce further easing measures, but this time with much more diminishing returns.
Okay, so that's what's happening. But what's the cause of it? How have we arrived at where we are?
We arrive where we are because we basically, if we go to the financial crisis, what central banks did was basically inject a massive amount of liquidity, expecting inflation to pick up and growth to pick up. Those two things happened, but in a very subdued way. Why? Because monetary policy basically perpetuated the imbalances that were built throughout the crisis, and basically what it only did was to transfer the risk out of the financial markets and into the balance sheet of central banks. What ended up happening then is that central banks got themselves into a trap because if they normalize policy, as we saw last year, assets fall very quickly and in a synchronized way, creating a very nervous feeling throughout markets. But if they don't normalize policy, what ends up happening also is that the results of those policies are less and less effective. So it's a very complicated situation, very similar to what we saw in Japan in the early 90s, is that the central bank goes from being the one that sort of solves the problem of a financial crisis to the enabler of financial bubbles.
So are we going through a Japanification process? Do you anticipate deflation globally, or certainly in the major Western economies?
I wouldn't say deflation, because inflationary pressures exist, but disinflation, yes, and definitely inflation below the central planner's expectations, for sure. Think about this. What we are seeing on one side is that very low rates and high liquidity perpetuate the imbalances, maintain the overcapacity. The businesses that are not working properly, they are refinanced endlessly. So what ends up happening is that zombification of the economy happens. We see, for example, the number of zombie firms rising globally, and that is disinflationary. Also, the fact that China needs to export more in order to address its own problems of debt and overcapacity is disinflationary, because they devalue the yuan, prices come down, etc. So I think that what we're seeing basically, what we end up seeing is that central banks see that there's a collateral damage of the policies that they're undertaking, which is that growth is lower, that inflation is lower, but they prefer that rather than seeing an abrupt fall in asset prices.
Well, that doesn't seem to be stopping. We've got the US now cutting interest rates. The European Central Bank is standing by possibly more QE. So it seems like the big central banks are just wanting to keep on heaping on the band-aids that I think have been put into this rather dysfunctional economic situation we're around at the moment. That then is just perpetuating whatever the inevitable is.
Yes. Well,
what is the inevitable?
The inevitable is a period of prolonged stagnation, because what the central banks are not going to be able to do is to normalize to the level at which the economy would go through a cleanup process. Because the cleanup, when there's too many pockets of bubbles out there, the famous bubble of everything, is very, very difficult. When central banks started their aggressive monetary easing, many investors already warned about the risk of inflating asset bubbles, but they saw it as a collateral damage, something that could be sorted out or even addressed afterwards. The problem when the asset that you inflate the most is sovereign debt is that you create almost a domino effect on every other asset, and that's why this concept of the bubble of everything. And if you start normalizing, a very small increase in yields generates a massive sell-off in other assets. So it's a very complicated situation.
So do you think there's any connectivity then between what we've just been talking about, the US trade war, the political developments as much as anything, people feeling marginalized, they want to bring in politicians that perhaps maybe represent a different sort of interest within some of these economies. We've got the yuan devaluation, which you mentioned, the Argentina looking like it could well end up defaulting. To what degree is there a connectivity between all of what's going on at the moment?
There is a connectivity. You can all trace it back to the idea that structural imbalances can be sorted via monetary policy, and that the only thing that countries need to do is to rely on it, not undertake structural reforms, etc. By that, and seeing asset bubbles, asset prices rise dramatically, the perception that the ones that have been most benefited and disproportionately benefited from monetary policy, being the rich, the wealthy, the ones with access to assets and debt, obviously becomes a generalized view. And then populist messages come to the fore. So in essence, the moment that for some strange reason the general recipient of information saw that money can be free, tended to believe that it is, and it is not. It is not. It is the problems of QE are not solved by more QE.
So let's bring up this chart then. This is the S&P 500. This goes back to 2015. We're what, 4 or 5% away from record highs. This doesn't represent to me any fragility within the system, although does it?
No, absolutely it doesn't. I mean, it shows that the S&P 500 has been rising dramatically alongside money supply growth, and that the reason why the US market has been performing so fantastically well compared to other markets like the European one is the main difference is buybacks, is that companies have used a lot of that extra cash to buy back their own shares and therefore improve the valuation.
And that's a function of QE, isn't it?
It is a function of QE, absolutely.
So there's a connection there.
There is a connection between QE and the rise in buybacks, absolutely there is. Because the idea that more liquidity and lower rates will drive higher investment is simply nice theoretically, but companies are, there's absolutely no evidence that companies are investing less than what they need, and even less so that companies are not looking at organic opportunities. But if you place enormous amounts of liquidity into the market and very low rates, absolutely the companies will look for the best way to utilize that cash, which is, in this case, buying back shares above and beyond investing.
You're not an equity analyst, I know. You're an economist, a global economist. But broadly, what we've been talking about, is that going to see more money going into equity markets, what we've been talking about?
I think that what we will see is that we will see a lot more money going into bond markets.
Bond markets,
Bond markets.
Which will push the yields down.
Which will push the yields down. And as such, equities look optically cheap relative to bonds. Because once you see, as we do in the Eurozone, on a 2-year maturity, you can see that all of the Eurozone countries are financing themselves at negative rates. Well, obviously the Eurostoxx 600 looks fantastic, you know? And the same happens with the S&P 500. The S&P 500 is a bellwether of the U.S. economy, no? And a U.S. economy that is more protected of the global uncertainties because it exports very little. It depends a lot on the consumer, and it's very influenced, the S&P 500, by technology. Obviously, those are big driving factors.
Yeah. Let's bring up this chart. Dollar basket, weighted basket of the dollar, currently trading 96.95. This goes back to 2015 as well. What is this telling us? Because the dollar is traditionally a safe haven, but the US is cutting interest rates. What about the dollar? Where's the dollar sit in all this?
Well, the great thing about this chart, precisely that it goes back so much, is that it shows that when so many people out there are saying that the problems of such economy or such markets are because of a strong dollar, well, it is not. Look at the dollar index.
Yep.
It has done very little in that period of time, no, and is actually not strengthened in a longer period. I think that what it is showing is that in a global monetary problem, the US dollar as the world reserve currency is going to continue to be a safe haven, despite the fact that, as you very well said, that the Federal Reserve continues to cut rates, and that it might even start a process of unwinding quantitative tightening and going into quantitative easing. So in essence, it's a game of who loses more. This is the problem of when everybody undertakes the same monetary policy. In reality, nobody is doing anything.
Yeah.
You see, everybody's pumping liquidity. Everybody wants their currency to go down. If everybody wants the same thing, nobody achieves it. No.
Yeah. Let's begin to sort of wrap this up and bring it all together. Any safe havens you like at the moment? Is there anywhere in the market where you think, yes, there's something where we could go which will give us safety?
I think you need to be involved in equities. I think you need to be involved in equities despite the short-term volatility, because if you want to have some level of value out there, it is much better, money is much better invested in the long term in equities in which companies are actually doing their job, improving their cash flows and reducing their risks. So if you strip out the most cyclical part of the equity market, you have still in industrials, in healthcare, in different segments, companies in which you can continue to invest and invest, with reasonable valuations, again, relative to bonds. In terms of bonds, I personally prefer US bonds rather than Eurozone, Japanese or emerging market bonds. Why? Because when the message that is sent to markets all over the world by every central bank except the Fed is sell my currency and buy dollars, that's what you're going to do. The companies that have cash will put their money in treasuries. Those central banks are going to be buying treasuries. So I still continue to believe that treasuries are a better place to be. I also like gold. I think that gold here is a good hedge towards the volatility of a slowdown that can be generated by the evidence of a slowdown and disinflation.
Yeah, spot gold here, we're at 1526, 6-year highs. So you see a continuation of this. Do you like, as an investor, do you like gold, or do you like the companies behind it, so you can get the lever of the increase in price in gold? But
yeah, as with other commodities like copper or like oil, if you like the fundamentals of the commodity, buy the commodity. Because in the case of gold mining companies, some of them are quite attractive, but the majority of them lose money when gold rises. Their costs go up, their extraction costs go up. So it's not necessarily a good, like with oil companies, that it's not always a good idea to buy oil companies when oil goes up. So buy the commodity. I prefer, the fundamentals of gold are strong. There are good mining companies, but you have to be a lot more, I would say, you have to pick. You have to be picky about them, in my opinion.
Look, Daniel, it's a pleasure. We've covered a lot of ground, but thanks indeed for dropping by to give us an update on your view of where we are in the global economy. That's Daniel Lacalle, Chief Economist at Tressis.